every single gold settlement transaction will be Basel III, first tier, a high quality liquid first tier asset, and fully compliant. Otherwise, it wouldn't be fungible. And this is a real global price discovery process. And as it gains liquidity, it will push back against the underpriced paper diluted Western exchanges. And while these bullion presented at the local London fixes is actually Basel III compliant because it has to be deliverable, this current paper driven gold price suppression leg has really just opened one more opportunity for us all to join what every other central bank is doing, swapping, depreciating, debasing fiat currencies to load up on physical gold and silver, this time into bargain basement prices.
Silver is currently trading above $36 and maintaining strength after a series of aggressive attempts to push prices lower in recent weeks. Following a brief pullback, the metal has recovered and held firm above key technical levels, showing clear signs of renewed accumulation. Short-term corrections around the $35 and $36 zone were met with strong buying interest, suggesting that market participants are becoming increasingly confident in the structural uptrend. Despite temporary pressure around the end-of-quarter options expiry, the price swiftly rebounded, which aligns with historical behavior during periods of short covering and market repositioning. The persistence of higher lows and steady demand at critical thresholds reflects a broader shift in investor sentiment toward physical ownership of silver amid growing concerns about monetary debasement and systemic instability. This renewed bullish momentum in silver is unfolding against the backdrop of accelerating changes in the global monetary architecture. At the latest BRICS summit, member nations reaffirmed their commitment to advancing a multi-currency financial system, with gold playing a central role in settlement and reserve diversification strategies. In an interview, seasoned metals expert Andrew Maguire emphasizes that the expansion of BRICS-led infrastructure, particularly in clearing mechanisms backed by physical gold, is effectively creating parallel markets where metals are valued on genuine supply-demand dynamics. These developments enhance the strategic role of precious metals, particularly silver, in the evolving financial ecosystem. As Maguire highlights, institutions are increasingly aware of the divergence between physical and synthetic pricing, and this awareness is driving new flows into the metal. As pricing power increasingly shifts toward physical exchanges in Asia and emerging markets, the traditional mechanisms used to suppress metal valuations through derivative-heavy Western platforms are facing growing resistance. With the emergence of gold and silver clearing systems that allow near-instant settlement and full physical delivery, the metals are gradually being repriced based on real supply-demand fundamentals. According to Andrew Maguire, this transition represents the beginning of a global physical price discovery era, one that could ultimately redefine silver's valuation as both a monetary and industrial asset. The underlying trend suggests a unique opportunity for investors seeking exposure to hard assets at the core of a rapidly shifting global financial order. Now, we present the clips from Andrew's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Best thing to do, let's just pop in to the charts for a second, because I think it illustrates it so much better. Now, with that in mind, into this big gold rinse, let's look at the bullish silver structure. Now, for that, we're looking at the futures chart, which is currently trading at around about an 17 or 18 cent premium to spot. That will reduce to at par with spot towards the end of the contract. It started off at about 53 cents to premium. So just to understand that this is a futures chart. This is where all the gaming occurs. So that's why we look at that. So let's look at this bullish silver structure, which also exposes the Fed to undeliverable OCC bets that they're also trying to square. And if you remember in our last episode, which was recorded one day after the silver options bet was squared, in fact, around about here is when we recorded that, these official OCC bets were driven down to the exact 35.20 sweet spot. I mean, right to that level, sweet spot in spot was exactly 35.54 in futures. And what did we see? Immediate short covering. And we looked at it last time, but just really bringing your attention back to it. So the gold short rinse efforts into OCC that's being squared on the 30th evidenced another round of insider short covering in silver. And this was a coal-driven discount, and insiders knew to buy this back up. Reason being, with COMEX silver market paper settled liquidity alongside producer financing initiatives leaching out into the Chinese physical exchanges, silver has now largely escaped the LBMA stranglehold. And these same actors are having difficulty in containing silver, which has not fixed below spot 36 since the 5th of June. We would view any offers to sell silver at current levels as a stacker's opportunity to load up. This week's very productive BRICS summit just ended on Monday, and it elicited a pushback from Trump, who came back saying it was anti-American, et cetera, and talking about putting some big tariffs on the BRICS nations. But in keeping with the overall BRICS mandate of essentially taking barriers down and to empower multipolarity, the focus of the BRICS summit has been really on accelerating financial multipolarity, now facilitated with the expansion of the new development bank, the NDB, bolstering its intra-BRICS national currency trades benchmarked to a weight of gold. Even secondary, more everyday general BRICS pay transactions, which are not directly backed by a weight of gold, are settled within the BRICS clear system, where the FX value of each nation's currency is weighted by the percentage of gold backing up that currency. So with gold markets now being discovered in Asia, as Bloomberg recently drew attention to, it provides the BRICS autonomy. Now, Dilma Rousseff announced she came out, in fact, before the BRICS started. She announced the new development bank had launched a multi-billion-dollar investment fund. Now, you know where that's coming from. Now, Russian Finance Minister Anton Siluanov confirmed that the NDB is formalized as a BRICS sanctioned tariff-proofed cross-border settlement hub. They knew that the tariffs were coming. It's very important that they bypass SWIFT. And so this is backed up. What this program is backed up with loan guarantees for mega infrastructure projects across the BRICS sphere. So in other words, you don't have to go borrowing money from your enemy. So in short, with 85% of the world's population and rising economic weight, Trump's tariffs are really driving BRICS nations to actually consolidate resources. And the NDB will provide the necessary financing. And there's a lot of instruments under this initiative. It's huge initiative here. Now, there's a lot of public information available here. And this covers BRICS Pay, BRICS Gold-Backed Unit, the loyalty, the business version of BRICS Pay, and the upcoming loyalty programs. It's worth having a dig into this. It's publicly available. Gold, bottom line, is strengthening the BRICS currencies at the expense of the dollar. We also expect a new BRICS currency bill note to be launched. It was shown in front of the camera. Now, as gold is already being discovered in the Eastern physically backed markets, the formalizing of the financial infrastructures to support liquid global settlement is the final piece of the puzzle. And it will actually be the death knell for the COMEX if it doesn't become Basel III compliant. We've got Singapore, we've got Shanghai, Hong Kong, Russia, Brazil, Africa, Southeast Asia. They've got sufficient physical market liquidity to benchmark physical gold price discovery and to set gold on the decentralized, trustless blockchain rails valuing the gold price in real time and based upon real supply-demand fundamentals. This is what we've all been wanting the West to do for 50 years. Now, the BRICS nations in aggregate have accrued sufficient physical market liquidity to benchmark a self-arbitraging, fungible gold price for trade of a T+1 settlement, but it's actually going to be T+0. This 7-second settlement process will be set on the already tested 40% backed decentralized sanction and tariff-proof blockchain rails. Every single gold settlement transaction will be Basel III, first tier, a high-quality liquid first-tier asset, and fully compliant. Otherwise, it wouldn't be fungible. This is a real global price discovery process, and as it gains liquidity, it will push back against the underpriced paper-diluted Western exchanges. And while these bullion presented at the local London fixes is actually Basel III compliant because it has to be deliverable, these benchmark fixes currently only discover a small percentage of all of the CMA LBMA transactions. This is about to change. And as liquidity migrates into the globally fungible T+0 physical exchanges, a real supply demand will emerge and it will backwash into the FX fixes. So China's cross-border payment system, the CIPS, already interconnects 4,900 banking institutions. And while ignored by the mainstream media, it's not gone unnoticed that the Chinese CIPS platform overtook SWIFT transactions in May. So to sum up, this current paper-driven gold price suppression leg has really just opened one more opportunity for us all to join what every other central bank is doing, swapping, depreciating, debasing fiat currencies to load up on physical gold and silver, this time into bargain basement prices.
Gold is now firmly positioned in a structural breakout phase, with central banks stepping in to absorb every physical dip, while synthetic short selling continues to dominate the futures market. Recent market action showed heavy front-running and aggressive momentum shorting, but Andrew Maguire highlights that these are paper-based positions with no physical backing. The imbalance between paper and physical demand reached an extreme as futures and spot pricing nearly converged, signaling intense backwardation and revealing just how undervalued the market is. Physical buyers, including sovereign entities from the East and the Middle East, took full advantage of these artificial sell-offs. The resulting short squeeze, with minimal speculative noise, reinforces the idea that a higher, physically driven stair-step pricing structure is now in motion. At the same time, BRICS nations continue to accumulate physical gold at record levels, with both official and unofficial holdings far surpassing what's acknowledged by Western reporting. This accumulation is part of a broader move to exit the weaponized dollar system and shift toward a physical, deliverable gold settlement infrastructure. According to Andrew Maguire, the U.S. remains the last major central bank clinging to outdated valuations, while others have already started benefiting from repriced holdings. As physical markets in Asia and beyond gain liquidity and take over pricing from the synthetic futures space, a global repricing event is nearing. Once the U.S. revalues its reserves to reflect current global conditions, a cascade of central banks will follow, likely driving gold to a new, sustainable valuation level that reflects its true monetary role.
Further illustrating this current central bank-driven rally is the next in a series of higher physically supported stair steps. In volume terms, at 36,000 tons, central banks now officially hold more gold than they have ever held since 1970s. It's well illustrated there. However, what's not reflected here is that a large percentage of central bank gold reserves bolster military assets. And as such, real gold assets are as closely guarded as a secret as weapon systems and strategies. And this is why official reserves do not include unreported BRICS, which is primarily Russian, Chinese, and Saudi, 400-ounce monetary gold accumulations, which also picked up significantly in March 2022. So not including what is secretly held by the Chinese generals, empirical evidence suggests that in aggregate, including the 2,292 officially held reported gold that China owns. Beijing has salted at least 35,000 tons of gold inside the state-held banks. I'm not alone in thinking that. That is widely held view from anyone that's connected to China. And in addition, there's 31,000 tons of official Chinese citizens' gold that they own that exceeds that of India's private holdings, which is about 30,000 tons. So it's now exceeded that. Now, while there have been multiple Indian government attempts to incentivize their citizens to lend their gold, deposit their gold into government-sanctioned lease buyback structures for the purpose of their governments, what do you think? Leasing into the market to protect the foreign, as part of their foreign exchange strategies to maintain the value of the rupee. All of these efforts have failed to attract any interest. Why? Because Indian people are too savvy to be suckered into that. Whereas if we compare that into the very real threat of a US-China, South Seas, Taiwan war, should Beijing need to bolster their already large gold reserves, as we saw a trial ballooned in 2023, which we covered in an episode back then, Chinese citizens' gold could be patriotically leased into the state with the PBOC assurances it would be equitably returned at a higher price. In other words, an investment choice. As such, in a time of war, Chinese physical reserves could amount to a massive 70,000 tons of gold. That is a huge number of accruing of gold. And also, for the same reasons, the 2,330 tons of officially reported Russian reserves are also grossly underestimated, more likely closer to 12,000 tons. In aggregate, current BRICS countries hold in excess of 10 times as much gold as is held by the US Treasury. However, while BRICS gold is fully fungible and 100% Basel III compliant because it's physical and it's deliverable and fungible, US Treasury gold is reported to be directly linked to these billions of the likely rehypothecated, unallocated OCC bets, which is currently in the late stages of being stick-handled by Citi and JP Morgan. In fact, the only global central bank left fighting a rise in the gold price versus the dollar is the Fed. And as we've just witnessed into Monday's most recent OCC mark-to-market event, billions of dollars of non-Basel III compliant, unallocated FX gold derivatives had to be squared. However, with less speculators left to wash and rinse these liabilities into physical demand, it's all about to change. Now, add in a late in the day reconversion to gold by developed market central banks. That's undoubtedly going to push gold higher. And here, have a look at the sheet here. And really, retail buyers are only just waking up to gold as a safe haven alternate to US Treasuries. With many funds not mandated to own physical gold, they have to buy an ETF. So US-facing gold ETFs have actually started to attract very sticky long-term investment demand that is very difficult to rinse out in traditional ways. So in order for the Fed to unwind its impossible to maintain gold pricing efforts, there's only one solution. Treasury gold must be revalued from $42 to market. And for US Treasury gold to mirror or equally globally fungible Basel III NSFR compliance, billions of non-Basel III compliant, unallocated FX OCC bets have to be bought back at market. So as soon as the Treasury gold revaluation account is marked to market, every other central bank will do exactly the same. Thereafter, the US will join every other central bank that is already benefiting from a higher gold price. and liquidity providers estimate most likely gold will rally to a realistically plus or minus $8,000 fair value per ounce.
The future price of gold is expected to experience a substantial upward shift, driven by a persistent and growing physical demand that far exceeds the availability reflected in paper futures markets, creating a deep and sustained imbalance. Central banks, sovereign entities, and major buyers have been steadily accumulating physical gold, tightening supply and diminishing the influence of speculative short positions, which artificially suppress prices. This dynamic has resulted in gold being undervalued relative to its true worth, signaling a forthcoming market correction as holders begin to adjust their reserve valuations to align with physical market realities. This repricing is likely to trigger a cascading effect where other financial institutions and market participants follow suit, accelerating the move toward higher prices. Additionally, ongoing global financial uncertainties, shifts in currency valuations, and the growing recognition of gold as a secure and tangible store of wealth in volatile economic conditions are expected to reinforce this trend further. Could gold and silver prices break past their historical highs in the coming months as industrial demand and investor interest continue to surge? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.